Hey, welcome back. I am going to wrap up the third part of Know Your Money, Know Yourself. What I was just talking about was the importance of earnings calls. And again, they last about an hour maybe. The first half hour, 20 minutes, half hour is usually the leadership of the company talking about the financial results and strategy and the forward guidance, and then after that they take questions from analysts. But even if you only listen to the first 10 or 15 minutes to really get a feel for this company that you've put your money and faith into and the leadership behind it, I think it's crucial. Also, that being the case, thinking about those analysts on those calls, you know that brings me to another saying on Wall Street, and that is that everyone talks their book. And that's to be expected. We whether you're an analyst and you cover semiconductors or energy, whatever it might be, they are they you know they're paid for the successes of those companies and the correctness of their calls. And so generally speaking, you don't, see a lot of downgrades, you see a lot of upgrades and price target raises by the analysts. My point being is that just whether it's you yourself as an investor or looking at the analysts or watching the guests, the pundits on TV or whatever you read, just for me, I always divide by what I know is them talking their book. Some do it more than others. You'll find some analysts that are just crazy with their numbers and their how effusive they are about a stock and its future. And so I always like to stay grounded. And like I said at the end of the last video, like Jamie Dimon, I always like to sort of divide further under, promise myself. And I'd rather be pleasantly surprised. And so, knowing you, so that's the analysts and all that, but doing the same with yourself, knowing your biases and your biases, and knowing your emotions too. We'll go into more detail about fear and greed and uh, what part those play, and then how to use those to your advantage when it comes to the market, but also to not let that blind you to really being honest. And every day I wake up, I try to take an eraser and start fresh, start new, and not root for anything that I want to go up or something that I might want to buy that comes a little bit further down so I can get that really great price that I wanted. I always try to reset, my biases every day. So I highly recommend that. And then, knowing, analyzing your successes and failures. Look, in investing, we are all going to make money and lose money. Everyone does. And I don't want to be too simple, but I love simplifying something that's a little bit more complex. And that is that you just want to win more than you lose. You want to have more successes than failures. You want to make more money than you lose, the money that you lose. And for me, a general ratio that I prefer or that is my goal is a 75% win ratio. So for every $3 for every $1 I lose, I want to make $3. If you can have that 75%, one loss with three wins, then, and knowing how to manage your wins and your losses, But overall, you've got a trading platform. I use Schwab. You can use Robinhood. You can use Fidelity. There's so many, great. We have such great technology these days. We're really lucky, in my opinion, that you can always go in, log into your account, pull up your portfolio, and track your gain loss percentages, absolute dollar amount, ratios for the year to date, if that's the way you like to do it. And you can always keep checking in on that. And with that in mind, you know, if my ratio again, 75% is my goal. I love it when I get to 80 or above. But let's say I start falling below the 75 and I get down to 70 or 72, 70, and I'm going in the wrong direction, then at that point, that's when I do that gut check and I'm like, okay, I am pushing for to find that profit. I am pushing maybe a little bit too hard. So that's when I intentionally use my results, my metrics, and realize that, okay, you know what? It's time to take a breather and to reset and to just, you know, close the laptop, push away, take an hour, take a day, take a week, whatever it might be, and come back with fresh eyes and let the market reset while you reset. I find this to be very helpful rather than really like trying to push and trying to make up for, a decreased percentage or a loss, whatever that might be. I think that's a fool's errand. And so again, that's every day, doing that gut check is hugely important. And with that in mind, yes, those three wins are fantastic, and I give thanks, and then I quickly move on. I move forward. What I do instead is I pay much more attention and analyze more deeply the failure that I had. I go back to my original thesis. I look at my analysis of the company, the balance sheet, everything, the financial statements. We'll get into that in more detail because, again, I'm going to give you an easy overview that you can do in a matter of minutes for a balance sheet to look at a few key numbers: cash flow, profit margin, debt to equity, price to book, uh, just a few different ratios. And then we'll go deeper into it too at one point in time. But you don't need to spend a lot of that time. But with the failures, I go back and I go back through all of my steps and find out where it didn't work and what I could do to improve. And I just find by paying so much more attention to those that I think it's kind of obvious in life that we learn so much more from our failures than our successes, that's where I put my focus. So that next time I can remember that, put it into practice, and do even better. So I wholeheartedly, well, that's what I do, and it's worked well. So focusing on the things that didn't quite work out, and I put a note in here that humility is a superpower. And any time that I feel like, maybe I'm on a roll, maybe I'm just, racking up wins and my percentages are going up, it's at that point in time when I might also push away and say, okay, time to just take a breath and to recenter my humility. And it's interesting. I've got another quote in here from Charlie Munger, who is, rest in peace, was the partner of Warren Buffett at Berkshire Hathaway. Charlie was, man, that guy was smart and had some great sayings. And you want to talk about someone who could distill everything down to its very essence. He was hilarious. He was razor sharp, pertinent, got his message across, and go check him out and look at some of the things he said over time. But he was quoting Demosthenes when he said that nothing's easier than self-deceit. For what each man wishes, that he also believes to be true. So I don't know, just along with Socrates, this goes back into time that we try to fulfill that self-prophecy and we try to make things happen. So for me, just knowing that and dividing by a factor of humility is going to has worked for me to keep me honest and to keep me more grounded as an investor. And so the last thing that I wanted to talk about is, or the last two things. One, study history. And throughout these, I'm going to talk about books that I've read, like The Intelligent Investor by Benjamin Graham, um, like, well, there's so many great ones out there. And but studying history and knowing the history of markets and is so crucial because, you know, I want to learn like my dad, rest in peace as well. Such a great guy. Like he would say, if you can learn on someone else's dime, man, that, you know, a penny saved is a penny earned. And so if you can go back in history and see what people did throughout history and learn from that and read the teachings of these incredible investors. Another book is Peter Lynch from Fidelity that I mentioned. He wrote a book called One Up on Wall Street. Such a great book and so easy to understand. He takes complex, the complex and makes it simple and very interesting as well. So One Up on Wall Street is another one. But learning from history, I think, is inevitable, not invaluable, and it's saved me so much money and learning it through other people's mistakes and teachings. And so the last thing is I just wanted to tell you about some tools that I use. Um, just the logistics. Like I said, I trade on Schwab. I like that platform. It's got different accounts that you can incorporate. You can open up, a Roth or a checking account. They've got a card that is, linked to your account that, has no foreign transaction fees and free ATMs and all that kind of stuff. But so lots of great trading platforms out there. I told you that I use Yahoo Finance. I find that to be great. Uh, again, let's say you open up that app on your phone. There's a tab in there that, well, if you just scroll down a little bit and you're looking through the statistics right up on top and you hit more statistics, I think it's called, but you just hit more, it will pull up some very important numbers that you can glance at in 2 minutes. You can go through and look at those numbers that we've talked about that we're going to go into more detail about, such as the cash flow and the profit margin and their price to book and their price to earnings multiple, which we can talk about because you hear a lot about price earnings multiples or PE multiples, and just remember this for now, and we'll get back into it, that a PE multiple is not a great timing tool. It should not be used for that. Um, just something off the top of my head that in in this business of investing, there are so many acronyms because, well, I guess it's a time saver, but to me, I'm going to try not to use all those acronyms. Uh, and I'm going to try and just keep it simple. So instead of PE multiple, I'm going to say price to earnings multiple. Instead of CEO, Chief Investment Executive Officer. Um, Instead of RPO, I'll say remaining performance obligation. And so I think that that's, even if it's a review, I think it's fantastic to do. And just, you never know. You never know. Again, if you already know it, then you know it, and it's a reminder, and then it solidifies it. And again, keeping things authentic, keeping it simple and real, and So Yahoo Finance is great. You've got news, you've got the numbers, the statistics, you've got analyst ratings on there, which I don't like to factor too much into it. I don't, but I do know that there are individual investors and fund managers out there that, look, people pay attention to reviews. We all go and, you know, we're driving around and we see a new restaurant and we open up Yelp and we're like, I wonder what the reviews are. Oh, it's got 50 and it's 5 stars or whatever. So, yes, that matters. I know that the analysts' upgrades and downgrades and price targets, that these all matter. And you can find those every morning on CNBC, by the way. They have a list of some of the top analyst calls of the day, and you can go into greater detail too. And so that takes me back to CNBC. First thing in the morning when I get up at 5, I open Bloomberg. Um, Bloomberg News is fantastic. The Wall Street Journal is fantastic. I will keep CNBC on throughout the day, also Bloomberg. And what else? The Journal, the Financial Times as well. Fantastic. And then, a couple of a couple of browser windows that I've got open through, at least in the morning. One is called FinViz, which is FINVIZ, FinViz, and they've got a heat map on there. And in the morning, let's say or when you come home from work, you open that up and it will be practically a full screen of the 11 different stock sectors by size. So technology is much bigger than consumer staples, which is that big. But within those sectors, you'll see the companies represented again by size. Apple will be much bigger than ARM Holdings, uh, and uh, and then everything will be coded green and red, and you'll see it just gives a really great, to me, snapshot of the overall market for the day. Am I looking at a bunch of red? Am I looking at a bunch of green? You can see the sectors and be like, oh my God, my gosh, energy was just pummeled today, deep red, like crimson, maybe the color of blood. And then you do a little bit of research and find out that, oh, OPEC just raised their production limits, and there was a whole flood of new oil on the market, or whatever it might be. But you can just get, for me, it's just a really nice snapshot of the overall market, of the different sectors and the companies themselves. And you can float your mouse over there and it'll pull down what the percentages of those companies, and it's very cool. And then the other thing is stock charts that I always like to check in with the basics of what's going on with the technicals of analyzing a stock. And so the fundamentals are, what does this company do? What are its, uh, financials and financial statements, income statement, cash flow, balance sheet? But the technicals are, how is it trading? How is its price action? And so if you go to stock charts, and that's one example, there are a number out there, but again, all of this is free. And that's a part of what I'm saying, is that you don't need to spend, other than a couple of the like Bloomberg or the Wall Street Journal, and um, but these websites and apps, they're all free. So stock charts, you can just pull up the basic stock chart uh, of a company and put in, let's say Google, and it will show you, it'll have a nice graphic representation of the price, of the moving averages, the 20-day, the 50-day, and the 200-day moving averages, which is just the average of, how the price has been moving, and if the average 50-day price of the stock, the closing price at the end of each day, if that 50-day starts to turn and is coming close to the 20-day is coming, the 50-day, let's just say, is coming close to the 200-day, we can talk about what that means. You can look at the bar underneath and look at the volumes of trading and see a big spike in trading when the stock went down, and be like, oh, there was a panicky event where a bunch of people dumped, and then use that to do a little more research. Um, if you do the stock charts, I would recommend down at the bottom, if you don't want to pay for it, there are a couple of indicators. They've got what's called the MACD, moving average convergence divergence indicator. You can change that to the RSI. The RSI is the relative strength index, and by default, that's a 14-day window of the strength of the price action of the stock as well. The RSI we'll go into later. That's a good short-term indicator to me, for knowing maybe this is not a great time to buy if the RSI is up at 70 or 71, but if it's down 30 or 28, then I can see that in the short term, the RSI, the relative strength index, is down below 30 or 20, and in the short term, in those 14 days, it has a negative sentiment to it, and that's when you can find some great buys, if you're looking for just a one timing tool as far as getting into a stock. And so those are a couple of tools that I use, and we'll go into some other ones as we go along. And that's it. That's it for the beginning. I'm looking forward to jumping into markets and getting a real feel, and telling you everything that I've read and watched and analyzed throughout the week, sharing that with you, and keeping us all in touch with the markets and the happenings, and I'm excited to start this journey with you overall. So that's it for today's show. Thanks for watching Wall Street Weatherman, and I'll see you in a couple of days.